All right, welcome everyone to another episode of Gimme Some Truth International Edition. I'm still Michelin, joined by Stan Farmer and Keith Poniwaz. And our topic for today is just a general market update, right? It's been a little bit of a crazy year.
I think it's been kind of boring and, not much going on.
Actually, I don't think there's much to talk about. I'd rather talk about, do you think people will notice that we're wearing the same outfits we were in the other podcast?
In the previous podcast,
Yeah.
That's just being efficient.
Yeah.
That's what I call it.
Yeah.
So,
We do preach efficiency in all aspects.
Well, and this is, people will definitely notice Stan's outfit because there's a paucity of neon in his attire.
it's
Moi?
very subtle.
Yeah. Things have been happening in the markets, huh?
I don't know. That's what I keep hearing. So a little bit of volatility, of course. So we wanted to just give a bit of an update on what's been happening in markets and our views in general.
Well, actually, I was thinking about this morning because when I first started in the industry, I thought volatility was one of those words like Orwell would refer to in politics in the English language, where we try to obscure, we'll say, what's really happening. Volatility was kind of a slang word for the market is sucking.
Right.
But this is a case where we could say volatility is actually pretty accurate.
Yeah.
Because we're seeing these, when the tariffs went on, we saw huge downside. When some reprieves were pulled off, the U.S. market shot up again. Monday, we're recording this on a Tuesday, where Monday the markets were way down. Tuesday the markets were up again, and they could swing intraday again. We've seen a lot of days where rallies will start in the morning and fade by the closing bell. And I think it's a good reminder of something that's very important, is everybody views the markets as kind of where they're standing at that moment to be the truth. And, one thing as you get into this industry, when I see a price at the end of the day, it says, this stock, $100.
Right.
But during the course of the day, people are buying and selling that stock, and you have a bid and you have an ask, right? And as you study that, you may get some indications of short-term where prices might be heading. Oh, there are more sellers than buyers right now. That's not good for the short-term, price of the stock. But, it's a discovery mechanism. So what this volatility is responding to is right now the market, one, I think feels like it doesn't have complete information. Two, the information it has is not good for trade and global trade. And one of the oldest saws in the world is the market hates uncertainty.
Right.
And that's what we're trying to sort out.
Right.
So, there's two parts as we kind of talk about things going into this. One is the political reaction, all of that, but the part we're going to try to focus on, I think, as I tell my clients, is the Homo economicus part, right?
The what?
Yep. The man, the economist, right?
Right.
The ideal kind of figure who has access to all of the information and processes through it and tries to figure things out from there.
Absolutely.
That was very philosophical. I love that, Keith.
Right. So you do need to be a little bit philosophical to deal with some of the volatility. I think it helps, and it's good perspective because, we've seen some pretty scary moves in markets, right? So Stan, is it time to panic?
Well,
Very McLaughlin group ask question there from you.
first of all, let me just preface everything that I say with it's never a good time to panic, right? Panic is not a strategy, okay? Is it a good time to diversify? Is absolutely, and just like it's never a good time to panic, it's always a good time to diversify. And diversification and the benefits of it are always on full display in times of peak volatility, right? We have seen, I think, one of the most profound tilts or shifts in what they call investor sentiment that I can remember, right? Because it has gone from such lofty, post-election, highs to the toilet in a very little time, right? And we could sit here and talk about the cause and effect of the why. And yes, I mean, there's no question that we have a geopolitical situation going on right now that injects a lot of uncertainty, right? Trade wars, real wars, hostilities, a redefinition of alliances and partnerships, and different conflicting ideas about what the ideal U.S. economy should even look like, right? So mega uncertainty as to what kind of tapestry is being painted.
You weave a tapestry.
Okay. I was on a roll, Keith. Just let it go.
was it
Anyway.
over when the Germans bombed Pearl Harbor?
Yes.
Speaking of the Germans,
it wasn't over then, and it's not over now. But I mean, it's really a chaotic time, and that produces a lot of fear in the in investors that are paying far too much attention to each and every trading day and living and dying based on what the market's doing.
Well, and I think again, this is something that frequent listeners of the podcast and my clients have heard me say over and over again. The market is not your portfolio is the first thing that we want to stress, right? You have, if you're diversified and invested, you have stocks, you have bonds. Bonds will typically, in periods of uncertainty, hold steady or go up slightly, right?
Yes.
The other thing, Stan brings up is, I mentioned Homo economicus. There are two parts to this conversation, right? And I think moving out of the U.S. is a perfect example. So Germany has lifted, and since the conditions that caused World War II, they've had an idiosyncratic view of economics, we'll say, compared to the mainstream of the Anglo-Saxon, Anglo-American kind of thought process. And they've been really restrictive on holding back deficits. And they've decided that, hey, given the economic uncertainty, given the changing geopolitical landscape, let's turn on the cash spigot, and have lifted a constitutional amendment which will allow them to spend more cash. In pure economic terms, right? Fantastic for Europe, for Germany, right? Keynesian economics. They had a lot
of bullets in the chamber, whereas we fire them on COVID and we left them firing.
Well, I mean,
right?
We didn't leave them firing, but we fired them on COVID, which I think people would agree was probably a time to, use your Keynesian economics, right? And it's why.
But we have huge deficits, and we have a huge annual deficit.
Yeah.
Okay.
Like deficits are, I mean, come on.
Homo economicus disagrees with that?
Yes.
Okay.
100%.
Cool.
Well, the disagreement here, Stan, comes from the fact that, as my econ professor said, it's what you're spending the money on, not having a debt. I have a debt right now. I have a mortgage, right? I pay my mortgage. Purely speaking, if you have a debt, that would be bad. Right. Also, countries are not people. Debt is not a bad thing. And we're getting way off topic here.
No, I was going to say, I'll let the two of you settle this offline around the coffee machine later, because I don't think, a half-hour podcast is going to be enough.
The point being, when we were Keynesian spending, the U.S. had, the Economist said it in October, an economy that was the envy of the world, right? Germany is now responding by putting money into infrastructure, putting money into, they were, 6 months ago, Sil and I were swapping Germany sick man of Europe articles, right? Mm-hmm. This decision to deficit spend, right, has reinvigorated their economy to the outside. What that means in the sort of longer term is we're likely to see Keynesian-inspired growth, right? Now, the counterpoint to the deficit argument of Keynesian is once you're out of crisis situations, you should be working to lower your deficit.
Yes.
Which happened, net spend of GDP went down. But the bigger point here being is that Germany has stepped up and started deficit spending to reinvigorate their economy, something that left the U.S. much stronger than every other country in the world coming out of COVID, something from 2008, 2009. It's why we saw 15 years of radical U.S. outperformance. Similarly, we could see now a switch like we saw from 2000 to 2006, where Europe now will, and Asia will surpass the U.S. because of that decision to stimulate their economy, something they didn't do in the previous two crises.
So I think your view is that the current trend that we're seeing of international stock outperformance versus the U.S. probably has legs and is likely to continue. And I think that's been a lot of the panic and the hysteria that we've seen, I think, so far this year is in part due to this sort of bias in investor perception. This idea that the market is really just the S&P 500. And it's really like in people's mind, they look at the S&P 500 and they think, this is the stock market. And, one thing that we've been talking about a lot and preaching over the years is, look, diversify. Don't just hold the Magnificent Seven, right? It's a big world out there. There's, great dynamic economies all around the world, even the ones that aren't trendy and that aren't, making the headlines for the right reasons and don't have the Googles and NVIDIA and Metas of this world in their indices are still worth investing in, right? And I think a big part of what we've seen this year is the S&P 500 fall a lot. But I think if you are truly a globally diversified investor, there's been bright spots as well in this market. So I think if you were going into this year with the right type of portfolio, it may still not have been a great year, but it's really not been as bad as you might think from the scary headlines and from just perceiving the market as being just the S&P 500 and nothing else, right? So you talked about your views about Germany, for example. I mean, the German stock market has been one of the great stories of the year, right? I'm looking at it right now. Year to date in US dollar terms, it's up about 20%. What's not to like?
Right? Very little. I like that.
So, right? So, again, I think there's a lot of nuances that are getting lost a little bit in the panic this year. And oftentimes, volatility, as you talked about earlier, what that ultimately means is it's about change, and there's a lot of changes happening right now. And, your portfolio should be ready for that, should be ready for change to happen, right?
Look, money finds a home, right? Money finds a home, and smart money finds a productive home, right? So sell-off in U.S. stocks has resulted in suddenly an attraction to non-U.S. stocks, right? Mm-hmm. And a sell-off, the fear factor and the uncertainty factor has led to another non-U.S. asset. We'll call it gold, because gold is setting record highs right now, right? So the fruits of diversification are always on display when the world's most favored asset comes under pressure. Right. And here we are.
And I think that's key in the sense that, so look, if you want a doom and gloom story, they're very easy to find online nowadays. You can read all about,
or on any channel.
It's very easy to go and Google and go on Twitter and read about the market collapse and the end of Western civilization and who knows what else. But I think we've seen some sharp moves, but we've also seen some bright spots. International stocks are one of them. Gold is having a great year.
International bonds
with the currency effect. have been a great place to be. I would even say obviously the dollar is weakening, but there's been a lot of talk about like the U.S. Treasury market, right? And how U.S. yields are under pressure. Now, holding U.S. Treasuries, has been mostly a good investment so far this year. And we've seen a very sharp move in the 10-year, and over like about a week, I think we went from about 4 to about 4.5 in terms of yield on the 10-year. But let's take a step back a little bit.
Okay.
Zoom out just a tiny bit. Okay. At the start of the year, the 10-year was 4.57.
Yes, and
First of January.
And was destined to go higher.
Right. Now, the 10-year is 4.37.
Oh, well,
but
you
the
mean
US
every
Treasury
expert was wrong?
Yeah, right. And also, if you kind of read and look at kind of the what people are saying, now it seems like the U.S. Treasury market is collapsing, when yields are actually lower than they were just a few months back.
Yes.
So again, I think
which is a sign that people are buying treasuries, right?
Right. Absolutely. So again, I think if there's a message here in terms of our market update, is look, the scenario that we're seeing now is there's a lot of nuances. There's a lot of volatility in both direction. There's a lot of changes happening. But it's also, there are winners in this scenario. There are assets that have benefited. And, if you went into the year with a portfolio that wasn't just the U.S. and wasn't just the Magnificent Seven, then chances are that, there's been some bright spots for you in terms of performance. So again, I think as we were talking about a little bit in terms of the importance of currency diversification in a previous podcast, I think this year has been a reminder of why we invest the way we do, why we always preach diversification, why we always tell investors to not just follow the momentum of the hottest trade of the day. And, sometimes you need to hold assets that, you're not necessarily in love with, that, are there because they play a role in your portfolio. They are there because the environment can shift quickly. And you can't just assume that the trend that you've seen in the last couple of years is going to continue.
Yes. So, Sil, on that note, not running to whatever's hot, right? We're not advocating that people dump their U.S. stocks in favor of international stocks, right?
Absolutely not. I
right?
mean,
and your favorite Warren Buffett quote?
What the market can say?
Buy when.
Oh.
Sell when people are greedy and buy when others are fearful?
Right. No, I mean, absolutely. I also think that the volatility can present opportunities. And I think some of the reaction that you're seeing now has been extreme, right? And we can kind of, when we talk to investors and prospective clients, there's a sense of panic about people, wanting to completely remove U.S. assets from their portfolio.
Yes.
Whereas just a few months ago, we were having to, almost fight with people to get them to agree to more international diversification. So, we look at it as practitioners. We're
the whipsaw has been huge.
Whipsaw has been incredible.
Huge.
I mean, and that's been perhaps the story of the year more than anything else. And Stan, you were talking about it earlier. If you look at investor sentiment surveys, and I actually wrote about it in my year-end piece, at the end of last year, sentiments were like at all-time highs, and the market was destined to go up in the next 12 months.
And that's the ultimate bearish signal, is it not?
And exactly. And now we're in this environment where if you're looking for reasons to be, you can look at sentiments that are in
the bar has been lowered.
J.P. Morgan has a chart that shows the average return, versus the Michigan Consumer Sentiment Index, right, in the stock market, and when consumer sentiment dips to these levels, the subsequent returns are statistically much higher.
Absolutely, and I think so. That's an important point. Negativity and bearishness in investor sentiments is something that makes your investments safer.
Bearishness is as fleeting as bullishness.
Absolutely,
it's just bullishness feels a little better.
It does. It does.
And investing your politics is also, I think, a mistake. I think people need to be objective and not boycott U.S. stocks if they disagree with, policy, if
Yeah.
you will, right? I think that ultimately that can end up being a huge mistake too.
Yeah,
right?
absolutely. Ultimately, I think Nate likes to say that the market doesn't care how you feel, and I think that's an important
It surely
reminder.
does not.
It does not. And to your question about should we dump all U.S. stocks? I mean, again, the U.S. stock market is still the largest market in the world.
Yes.
It's
Even
a
with the
key-
recent
That
downturn.
would be
with
that
the
would be a
recent downturn.
totally opposite,
64%.
ridiculous type of non-diversified portfolio.
Right, exactly. So it
was
would
to
be
exclude the biggest asset in the world.
it would be the same mistake as you would have made before, just being invested solely in the U.S. and
Yes.
not paying attention. So it would be the same, different side of the same coin. So again, we wanted to just touch base with our listeners and just share some of our thoughts on the crazy market action.
And now Stan and I
this
are going to
year.
argue about deficits.
And yeah,
afterwards.
you guys are going to have this heated discussion, and I won't
I'm
absolutely
gonna get lunch.
I want absolutely no part of it whatsoever. But we might see a phone and record it just for fun and sneakily post it on YouTube
outtakes.
later on, the outtakes. Thanks everyone for listening. Be sure to like and subscribe, and we'll see you next time for another episode of Gimme Some Truth International.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.